In this video, we are going to learn about the other two types of solvency ratio, that is proprietary ratio and interest coverage ratio. So let's start with proprietary ratio. So from the name, we can make out that we are generally talking about the proprietor or the owner of the firm. So this ratio is a relationship between proprietor's fund and total assets. What do we mean by proprietor's fund? This is the capital invested by the owner, which is generally named as equity or shareholders fund. So the proprietary ratio is equals to equity divided by total assets. This ratio generally shows what is the contribution of the stockholder in the total capital of the company or firm. Let's have a quick revision of the components which comes under equity and total assets. So equity, also known as shareholders fund, is equal to share capital plus reserve and surplus. There's another formula to this, that is equity or shareholders fund is equals to from total assets will deduct non-current liability, that is long-term borrowings and long-term provisions. Also will deduct the current liabilities. Total assets equals to non-current assets plus current assets. So let's start the practical question from DK Goel, question number 34. Share capital rupees 3,20,000, general reserve rupees 1 lakh, profit and loss balance rupees 48,000. So it's a profit since it's not written in bracket, neither loss is mentioned anywhere. 9% debenture rupees 1,20,000. Current liabilities 3,04,000. Non-current assets 3,60,000. Inventory 1,76,000. Trade receivables 3,28,000. Cash and bank balance 28,000. So first we have to find debt equity ratio, and formula is debt by equity. In the question we can find that there is only one debt, which is 9% debenture of 1,20,000. In the equity we will have share capital of 3,20,000, general reserve 1 lakh, and profit and loss balance rupees 48,000. The total of debt is 1,20,000. Total of equity is 4,68,000. That is equal to 0.26 is to 1. Next we'll find debt to total assets ratio, that is equal to debt divided by total assets. In the debt we'll have only 9% debenture, that is 1,20,000. In the total assets, let's find the component, that is in the total assets we'll have non-current assets 3,60,000, inventory 1,76,000, trade receivables 3,28,000, and cash and bank balance 28,000. So we'll add this four amount in the total assets. So total of debt is 1,20,000, total of total assets is 8,92,000. Dividing this two, our answer is 0.13 is to 1. Now let's talk about the proprietary ratio, which is equal to equity divided by total assets. From the previous first part, we know the value of equity, which is 4,68,000. We can directly write over here. That is the amount of share capital 3,20,000, general reserve 1 lakh, and profit and loss balance 48,000, which is equals to 4,68,000. In the total assets, from the second one, we know the value of total assets is 8,92,000, which is written over here into 100. So the proprietary ratio can be written in pure form and also in percentage form. It's better if we write in the percentage form. So we will multiply this fraction into 100. This will give us the answer as 52.47%. Next question, question number 36. Find debt equity ratio and proprietary ratio. Equity share capital is given as 20 lakh, general reserve 10 lakh, securities premium 5 lakh, 10% debenture 3 lakh, loan from IDBI 12 lakh, current liability 10 lakh, fixed assets rupees 40 lakh, current assets rupees 20 lakh. So debt equity ratio equals to debt divided by equity. Here in the debt we have two components, that is 10% debenture of 3 lakh and loan from IDBI rupees 12 lakh. That's the total is 15 lakh. In the equity we have share capital 20 lakh, 10 lakh of general reserve and securities premium 5 lakh. So total is 35 lakh. So the answer of debt equity ratio is 0.43 is to 1. Proprietary ratio is equal to equity divided by total assets. Equity In the equity from the previous part, we know that equity is 35 lakh, and total assets, and the total assets will write fixed assets plus current assets, that is 40 lakh plus 20 lakh, that is 60 lakh. So dividing 35 lakh divided by 60 lakh, dividing 35 lakh and 60 lakh into 100, our answer is 58.33%. Next, our next topic is interest coverage ratio. So generally, interest coverage ratio means that how capable the firm is in paying off its interest on long-term borrowings. So the formula for interest coverage ratio is net profit before interest and tax divided by interest on long-term borrowings. This ratio is generally expressed in times. It ascertains the ability of the company to meet its interest payment on its outstanding debt. So let's start with the practical question. Question number 39 from DK Goel. From the following information, calculate interest coverage ratio and give your comments also. Net profit after interest and tax is rupees 1,20,000. Rate of income tax 50%, 15% debenture rupees 1 lakh, 12% mortgage loan rupees 1 lakh. This 15% and 12% is the interest rate given over here. Now, in the formula for interest coverage ratio is net profit before interest and tax. Here in the question we have net profit after interest and tax, and the rate of income tax is given as 50%. So we have to find the net profit before interest and tax. So we'll apply the unitary method. Now see, if the rate of income tax is 50%, that means if my profit was 100, 50% of 100 is paid off as the income tax. So remaining is rupees 50. That is net profit after interest and tax. So let us take it as if the profit after tax is rupees 50, then the profit before tax was 100. Now if the profit after tax is rupees 1,20,000, then what is the profit before tax? So that is 100 divided by 50 into 1,20,000. This will give us rupees 2,40,000. So this 2,40,000 is the net profit before tax. Now we have to find the net profit before interest also, and 12% and 15% interest was mentioned before mortgage and debenture. So we'll do a working over here, that is interest on debenture 15% of rupees 1 lakh, which is rupees 15,000. Interest on mortgage loan 12% of rupees 1 lakh, which is rupees 12,000. So the total of our interest is 27,000. Now this 27,000 will add to 2,40,000, which is equals to 2,67,000. Now this 2,67,000 is the profit before interest and tax. Now putting it in the formula, interest coverage ratio, where the net profit before interest and tax is 2,67,000 and divided by interest on long-term borrowings. The interest on long-term borrowings, as we have done in the working, which is 27,000. This will give us the answer as 9.89 times. Now, it is considered that 6 to 7 times is a normal or a good rate of interest coverage ratio that the firm is having. 6 to 7 times is normal. So if the company is having 9.89 times interest coverage ratio, which shows that the company is having enough profit to pay off the interest on long-term borrowings. Therefore, we can say that the company is having good financial condition to pay off its all debt. And generally, the interest coverage ratio, if it is high, it indicates that the company can pay its debt or interest several times. While if it is having a low ratio, it indicates that the company may default on its loan payment. That's all for today's class. Thank you.